Welcome back to the Stuff About Money podcast. I am Erik Garcia, certified financial planner, one of your co-hosts, joined as always with Xavier Angel. Xavier, what's happening, man?
Not much, man. Everything is good.
Everything is good. We are getting tons of questions about the stock market, about inflation, about the economy. And we're not economists. We're just certified financial planners. We help people make decisions. So we lean on really, really smart people to help us understand what's going on. So we have two guests today who are joining us. My friend Erik Needham. I met Erik. Erik, you came down and we chatted here. You had a conversation with us and Xavier several months ago, and you were kind enough to introduce us to Kevin. I'm gonna let you introduce Kevin, introduce yourself a little bit more, and then we're gonna get into the meat and potatoes of this conversation. And we'll start there. Let's do some introductions. Go ahead, Erik.
Sure thing. Erik, thank you so much. Xavier, thanks for having us on. Erik Needham with Washington Crossing Advisors, asset manager. We've been around since 2000 and run equity, fixed income, and tactical asset allocation portfolios. As you mentioned, I'm joined today by our resident expert, Kevin Caron, co-founder, co-senior PM on the strategies, and just general expert in regards to anything macroeconomic that you want to throw his way. So please pick his brain as much as you can.
So PM, not Prime Minister, portfolio manager.
Portfolio manager, sorry.
Portfolio manager. Prime Minister, that's in the news these days, but portfolio manager. Kevin, did Erik leave anything out? Do we need to add anything to your resume?
No, good job. Thank you, Erik.
Yeah, so you've been doing this a while.
Yes. Yeah, I began my career in the early 1990s. I worked on Wall Street and came into the business at a time where we were transitioning from the roaring 80s, if you will, and all that brought along with it. We all remember Gordon Gekko and Greed is Good and the high yield bond market and all of that kind of stuff. So I came in kind of right at the tail end of that party. And then for the last 30 years, lived through just some interesting market environments, as we all have. So the tech bubble, the tech wreck, the financial crisis, the spectacular recoveries thereafter, high interest rates, low interest rates, no inflation, lots of inflation, Democrats, Republicans, all sorts of stuff.
You've seen it all.
Well, I haven't seen it all, but what we've seen is that the market does a spectacular job of working things out over time. But in the meantime, the ups and downs can certainly create a lot of anxiety and sleepless nights along the way.
Yeah, certainly there's been a lot of sleepless nights I know I've had conversations with some clients, but man, I love how you just walked us through 30 years of market history, and you hit these highlights of just a lot of challenges that the market has had, and yet, like you said, we're still here. Right. I think the biggest challenge, me and I'm in a mastermind group with other financial advisors. And one of the things that we talk about is managing investments sometimes is easy. Managing investors is the difficult part. Like we're dealing with emotions. You said greed is good. Greed is one of those emotions that we're not so much dealing with right now. When the markets are doing good, we have to deal with it. Right. We see what that can lead. Right now, the biggest emotion that we're dealing with is fear. And how do we calm our clients' fears and get them to make really battling? I was watching CNBC this morning. I don't know who said it, but they were interviewing the CEO of his name. I can't remember his name. CEO of Exxon, and he talked about battling short-termism, and I love that. So, all right, before we talk market, I want to hear from both of you one thing about money that you know today that you wish you would have known at the beginning of your career or 20 years ago. Erik, we'll let you go first.
About money. So 20 years, I guess the biggest thing that I wish I would have done more so 20 years ago when I first got into the business is just tax advantaged accounts. Just the socking away as much money as I possibly can into tax advantaged accounts from the get-go, so that they grow so much more, basically getting Uncle Sam away from it and keeping it in your own account for retirement.
So traditional IRAs, Roth IRAs, 401ks, those types of things.
Yeah, maxing out your Roth, especially when you're young. And I know it's hard, I know it's difficult, but it's just one of those things where not enough people ingrain that into your skull. Sure, you probably hear about it,
Yep.
but just the compounding on that, the account values you'd be at if I had done that 20 years ago versus it makes all the difference in the world.
You wouldn't be here today, man. You'd be on the beach somewhere and
Exactly, right? I could be retired at this point. Yes.
All right, Kevin, what about you? I mean, what's something that maybe you wish you would have known when you were a young man before you had all that 30 years of market experience?
I think it would be worry less. I think that there's a tendency to focus on things that are scary and dramatic, and especially when you're young. I think that worry, an excessive amount of worry, can really kind of cost you. And one of the things that I don't think I really understood when I was younger was just why is it that, for example, stock values grow as they do over time? Why is I had a business degree. I went to school for this, but I think that when you get caught up in a lot of drama, it's easy to kind of lose track of the longer term. So whenever I talk with people who are coming into investing, or just people I've met for the first time, the first question is, what is your time horizon? And that is the one thing that I think if I could go back and do it all over again, just to acknowledge that it's not so much that time heals all wounds, but the longer term time horizon is the right one to have for investing, and to really avoid all the negative implications that come with our human emotions. It can cause us to do the wrong thing at the wrong time.
Now you are speaking my language. I love that idea. And that's one of those things where, as financial planners, that's what we do, right? We want to help people put things in perspective, put financial decisions in perspective. I told someone the other day that sometimes the advice we give isn't always super sexy because it's long term, right? It might not give you the biggest deduction today. Back to Erik, you're thinking about tax planning, right? It might, but over time, it might save you more money. But putting things in perspective and understanding the role of emotions in decision making and putting them in their proper place, man. I love that. All right, let's talk about the market. Let's talk about the economy. Everything just seems broken, Kevin. It just seems broken. Yeah. When is it going to get back to normal? And what is normal?
You know what that means. I refuse to use the word new normal anymore, because we've had too many new normals over the last 30 years to count. So we're not going to say that anymore. I think the state of the world is now, always has been, and probably always will be, a state of moving from crisis to crisis. And those crises are the things that push us forward. If everything was just comfortable all the time and everything fit just right, there would be no reason for change. But the whole process of an economy and growth ultimately comes from a process of uncomfortability. So you can go back to you can start any time, but let's say we started in the 1970s. You had extremely high inflation. You had a significant underinvestment in productive capacity and capital in the United States. Ultimately, that created a lot of pain. The 1970s was not a fun time for a lot of people. Produced some really cool music, actually. There were some good things about the 1970s.
Escapism, right?
That's right.
You needed good music to cope.
Yeah, but ultimately, from that that uncomfortable place came some changes, and those changes then produced the next decade, and so on and so forth. So it seems to me that the process of markets always has to do with trying to find a comfortable place. Maybe economists call it equilibrium, but I would just say that in my experience, we've always been in some kind of crisis, looking to move through that to get to the other place. If there's a positive in all of this, I do see that most people tend to benefit simultaneously from things like an expanding economy. And so incentives are aligned at the policy level, all the way down to an individual who wakes up in the morning and decides to go to work. We all want to better our lot in life, and very few, from the policy level in global politics all the way down to local politics and individuals, families, and their own personal decisions. There's a real push and pull, because when we find ourselves in a bind, it creates an incentive to move forward. And I think that undergirding progress is that tension. And so again, right now today, we clearly have that attention with COVID, higher interest rates, the war in Ukraine, all of these things. But ultimately, we're on a path that will eventually resolve those things, because pain is a very good motivator.
So kind of what you're saying is, don't be afraid. Like, crisis might be normal. Like, this actually probably is more normal state when we have crisis. Straight up markets isn't typically normal. So having crisis isn't something we should be afraid of, because it is a little bit more normal. And friction isn't necessarily bad. One of my favorite proverbs, it says, as iron sharpens iron. There's the idea, like, if you want to sharpen iron, there's friction, there's heat, right? And so what you're saying is, a crisis in the economy could well serve as the friction necessary to further grow.
Sure, and markets are somewhat backwards, and the way we think about markets are backwards. I mean, just the easiest way to think about it: if something goes on sale at the store, we usually buy more. But when asset prices come under pressure, we typically run away from them. It's a very weird gearing of I'm like anybody else. There's a tendency to think that way. I think, as someone who's done this for a long time, we have a habit at Washington Crossing, for example, of looking at markets and trying to estimate what the expected returns are. And here's what we've seen at Washington Crossing. When prices go up, all else equal, expected returns go down. A bond investor will understand that immediately. And the stock investor should see it really the same way, that prices, paying high prices ultimately lower expected returns, all else being held equal. And so a couple of years ago, when we published our long-run expected returns at Washington Crossing, it was quite a sobering experience, because when things got really crazy during 2021, with markets hitting new highs and lots of speculation, well, when we put pen to paper and did the math, our expected returns on the stock market were down in the low single digits. It was actually kind of depressing. So even though the financial media was having a party as the markets were making new highs, when we did the math, we were kind of feeling quite the opposite. So today, when we do the same math in the same way with prices lower, we're now seeing higher expected returns. And that's actually a positive for us. So it's good to be invested in the stock market for growth, yes. But if you can invest in the stock market for growth, but then have the sensibilities of a bond investor, I think you've got really the best toolbox you could possibly have to be successful over the long term.
So what you just talked about there, I think, hits on the head exactly what you said about the emotional side of investing. Like, everything you just said, it's really hard. Like, everything's good, everything feels good. So hey, I wanna invest now. Well, it's the most expensive time to invest. The best time to invest is like when it's terrible. There's a really interesting stat put out by I think it's University of Michigan, the sentiment measure.
Yeah.
And if you would have invested at the lowest, at the trough, the lowest, like, consumer sentiment about the economy, like when everyone was feeling the worst, your next 12 months expected return, I think, was somewhere right around 24-25%. As opposed to investing at the highest, at the peak of the sentiment meter, your expected return over the next 12 months would have been somewhere around 4 or 5%. So exactly what you just said about the data that y'all follow and let it inform your investment decisions is backed up by you don't need me to affirm your investment decisions. You've been doing this long enough, but it's cool to see that.
Yeah, and I'll say that most of this happens, most of the anxiety happens at extremes. I mean, I'm a human. I have emotions, but I remember the late '90s being a very stressful time as the markets were soaring to new highs, trying to square all this. And sometimes the emotions can be euphoric. In other words, I bought something low and now it's high. Whoopee, that's great. Well, what if you didn't buy it and your friend did? Then you've experienced regret. You feel, I missed out on the boat. And maybe you feel like compelled to throw in with everybody else and to make a purchase, even though you haven't really done the math or you really aren't thinking about it with your rational brain, but you're being compelled emotionally to throw in the towel and jump in. And how many times have we heard the story of the investor who throws in at the last minute only to find themselves burned? So yeah. I think to have that, now to stay away from that, I think to have that longer perspective, you should be asking yourself about, the next 10 years or so, and recognize that you have as a person have to live a life. Most people have jobs. Most people are educating themselves. Most people are bettering themselves, creating cash flow in terms of an income, hopefully. But on top of that, if you're an investor, you have another engine of growth, which is the capital that you have accumulated. And you have to understand that, especially in the case of stocks and and bonds too, that capital is working for you on top of what you're doing with your own job and creating income. So when you combine those two things and you recognize that as an entity, you're creating personal wealth in two ways: by bettering yourself, becoming educated, working, bringing in income, cash flow. It's a flow concept. But then at the same time, you've got capital that, even though that old adage that let your money work for you, it is true that the compounding effect of stocks and bonds can be very powerful, but usually over the longer period of time is where you see the benefit of that. Man, so maintain that longer view.
You just beautifully tied together the thing that Erik wished he would have did 20 years ago and the thing that you wish you would have known 20 years ago, perspective and compounding, and you just beautifully threaded it together. I don't know if you intended to do that. Let's go back to something you said earlier about this idea of friction and crisis and how it's not necessarily all that bad. Then you talked about rising prices and the valuation of stocks. Rising prices, inflation, that's something that we're really dealing with right now. It's hot and heavy. By the time this episode drops, the Federal Reserve will have had their meeting in November, and everyone's anxiously anticipating to see what do. Do they continue their aggressive rising of interest rates, right? And they're doing that to try to curtail inflation. Talk to us about inflation. What should we be expecting? And even just the idea, like, well, what's the big deal, right? If things get more expensive, but yet we pay people more, right? Social Security is going up and pension payouts are going up because it's all pegged to inflation. So if everything just gets more expensive, what's the big deal? Why does it impact the economy? And why does the Fed want to basically, get us to the verge of possibly recession to solve the problem?
Yeah. All right. So we're entering a red zone for this conversation, and so I'm going to throw a flag on the field and say I want to define a term before I answer your question. So the way that we look at inflation is that it's a change in the value of your money for the worse. We always talk about it in terms of, in the headlines, well, the consumer price index is up 8.5%, or et cetera and so forth. But really what's happening is the value of the money that you own is being diluted. Well, how does that happen? Well, for the most part, it happens when the government prints a lot of money, or through the financial system, money is printed. And we all can recognize this very easily. If you have a collectible and it's rare, it's going to be very valuable. If you print up a whole bunch of these collectibles, create a lot of these collectibles. I don't know how many of you remember the Cabbage Patch Kids 30 years ago when they first came out. Everyone wanted to get a Cabbage Patch Kid. Yeah. You come back 6 months later, there's a zillion Cabbage Patch Kids. They're not worth anything. So it's the same thing with money. If there's a lot of it that's printed, it's worth less. And the way it shows up as higher prices. So initially, if you see higher asset prices, stock prices, bond prices, usually not so much bond prices, but stock prices or real estate prices, then you feel wealthier. And that's a good thing. But then as time goes on and we start to see those prices showing up at the gas station and what we have to pay to live every day, then the pain comes. So inflation has been with us for at least 100 years. And as it goes, that process is something that's very dangerous to your money. And if I had to just bottom line it, my grandfather, I don't know, 80 years ago, 90 years ago, if he had $100 bill and he could have invested it in the stock market or, in gold even, or real estate, or put the $100 bill in his, under his mattress, well, maybe in 1930, that $100 bill might have meant a lot to him. Today, $100 really isn't worth all that much. But if that same $100 was invested in stocks or gold or real estate or whatever, it would be worth something considerable today. So the whole reason we invest is to protect over the long run against the destruction of the value of money, which is very obvious today.
Yeah, so it's one of those risks that we think we're avoiding, right? We try to de-risk our portfolios, and sometimes people try to de-risk for too long, and they've introduced this new risk in their portfolio, inflation risk. Like your money's just sitting there.
Or just think of it this way: at the price of everything that you look at, we see it as a number. So you have a $1 million house, let's say. Well, it's $1 million. That's a number, but it's really a ratio. It's one house for $1 million. There's two numbers. Mm-hmm. And when you see the value of that $1 million house go up, it may be that the house hasn't become intrinsically more valuable at all. Well, if the house hasn't changed in value, it's the same house.
Here's what I don't understand.
What you're really seeing is that the value of your money is being diluted. So the question then becomes, well, if putting your money under your mattress in the long run risks having it diluted, then you need to put your money in some other vehicle. And typically it would be hard assets or stocks as a hedge against inflation. Where you really tend to get more hurt is as a bondholder, where your future cash payments become eroded. And that's why bonds have suffered badly this year.
Here's what I find interesting. As long as I've been in this business, I started in 2001, really went independent in 2008. And that's kind of when I would say I really started, hard on the investment side. Yeah, I had my licensing, we were doing smaller stuff, but that's when I really started doing advisory business. And as long as I can remember, we've had historic low interest rates, as long as my career has been around. And people have always talked about, we're going to pay for this one day. We're going to pay for this one day. Inflation is going to go up, but interest rates stayed really, really low. We're going to pay for this one day. And all of a sudden now we're paying for it. And everyone seems surprised by it. Like, oh, inflation is so high. And I'm like, why are we surprised? Like, yes, we're looking backwards and, oh yeah, we should have saw it coming. It should have happened. And we all play, it's always easy to look, hindsight's always 20/20. But like, we shouldn't really be surprised by what we've seen this year, should we?
Well, you've had a tremendous amount of money created since the pandemic hit. The federal government and the Federal Reserve essentially worked together to put into existence about $5 trillion of additional money. If you look at a measure of the money supply, the most common measure of the money supply, you'll see that the supply of money in the economy has increased by about 40% in the 2 years post-COVID. So to put that in perspective, back in the 70s, when we last had a big inflation problem, there were two surges in the 70s. In 1970, I think 2 and 3, the money supply grew by 20% in that interval. And then in the later 70s, I think it was maybe 76, 77, it again grew by 20%. And we had a terrible inflation in the 70s. Well, in a 2-year period during COVID, the money supply didn't increase 20%, it increased 40% in one shot. And it was enormous, the amount of money that was put into the economy. And arguably, you now have more money chasing fewer goods. So when you look at the ability of the economy to produce things, economists, including at the Fed, have been reducing what they think the economy is capable of producing. So you've got the perfect storm for inflation now. You've created a lot more money, and arguably, when you look at productivity and supply chains and all of that, the ability of the economy to produce things has stagnated. So that's the perfect storm for inflation, and that's why it's in the headlines so much this year.
So when the Fed raises rates, talk us through this real quick, and then I have a question. I want to switch subjects here for a second. So as the Fed raises rates, how does that combat inflation? Talk us through that.
So if the Fed is cutting interest rates and buying assets, they're essentially injecting money into the private economy. We can all think about this when we borrow money. You go to the store, you have a credit card, you go to the cash register, you swipe your credit card, you're creating money. You've got a bank essentially that's creating money to settle that transaction at the store. If the money is cheaper to borrow, it's going to be easier to go to the store and spend that money. And so we collectively create money in that way. The government does it the same way. The government may come along and say, well, to build roads, bridges, or to supplement people and businesses during tough times like the pandemic, we're going to inject money into the economy. The Treasury borrows the money, the Fed buys the Treasury bonds. Well, it's another way of putting money into the economy. So the process of lowering interest rates and having the Federal Reserve buy assets, usually the bonds that are sold by the Treasury, that's your textbook way of creating more money in the economy. And by raising interest rates, and by the Federal Reserve selling assets, you're putting that whole process in reverse. And that's what's happening now. And the good news is, if I could fast forward to this part, is that if you look at the last 6 months, there's been essentially no growth in the money supply. So after tremendous growth for the first 2 years of COVID, which created a lot of inflation, you now have had a 6-month period with higher interest rates and basically no growth in the money supply. So if you follow that through, there's a reasonable chance that within a year or so, we'll start to see a flattening out of this inflation problem. But all of this is a reminder of just what a threat inflation can be and how it works.
All right. You just said something. This actually is going to lead me to the next question I have. And people are thinking, oh my gosh, Kevin just said a year or so. We have to live through this for another year. Are we going to live through another year of 2022 markets? I've always been fascinated by the difference between the economy and the stock market, and they're really not the same thing. They're tied. Their fortunes are tied to each other. But talk us through that. Do we have to live through this for another year? And what do we know about the stock market and the economy, and how do they work in tandem?
Well, let me change a little bit. It's not so much in the long run. There's a very significant connection between the stock market and the economy. If I drew a graph of the economy for the last 70, 80 years, and I laid on top of that the Standard & Poor's 500, drew a trend line through both, you'd say they both go up about 7% a year. And there's a reason for that. Productivity growth in the labor force, a little bit of inflation, put it all in a bag and shake it. And for the last 80 years, you get about 7% growth, both in the economy and in the stock market. No big surprise. However, I think what you're really getting at is what happened this year was not a disconnect between the economy and the market. It was a disconnect between what the market expected at the beginning of the year and what actually happened. Let me parse that a minute. So at the beginning of the year, if you were to ask the financial markets what they thought, what the markets thought collectively about interest rates for the next 10 years, the answer would have been, just like you said earlier, a continuation of essentially 0% interest rates for the next 10 years. The market was completely asleep to the question of higher inflation and higher interest rates back in January. The spring came Inflation woke up the Fed. The Fed got very concerned about inflation, started aggressively raising interest rates, and shocked the market, who, like you said, when you came into the business, it was low interest rates, has been that way for 20 years. The market did not expect the sea change that they had this year, and suddenly the market found itself in January offsides and had spent now the last 9 months correcting the earlier misassumption that we would have low interest rates forever.
Mm-hmm.
And even though we feel like, oh my gosh, we've been talking about higher interest rates and inflation forever, the reality is the market has had to go from an expectation of no interest rate hikes basically at the beginning of the year to now, what seems like high inflation and endless interest rate hikes now. And that process of adjusting between what was perceived and what turned out to be is the thing that caused most of the volatility we've seen this year.
And to kind of go back to what you said earlier, crisis to crisis, this is a crisis. And, I talked about battling short-termism. The challenge for us as investors is, what do we do with this information? What do we do with this data? What do we do when we see our quarterly statements? Like they're terrifying, right? To see some of the drops in our portfolio values.
Yeah. Well, I think acceptance is a big part of this. I like to say we always tend to feel like we own too much of the things that go down and never enough of the things that go up. It's just part of investing. But accepting kind of where things are is very helpful. I think that having a perspective, that longer perspective, is kind of important. And I would go back and I would say, well, where was I 10 years ago? What was my financial situation 10 years ago? And where am I today? And even though we've had some diminution in the value of the stock market, as I said earlier, it's not necessarily all unhealthy. The run up in 2000 and 2020, 21 was equally as unhealthy in some respects, if not more so, than the process that's happening today. Talk about a bond investor. The 5-year Treasury bond is down 13%, worst year in record for a very boring 5-year Treasury bond. The fixed income investors have been hurt. They've had a drop in the value of their portfolios. However, the good news is that we do now have a rate of interest that is attractive. Mm-hmm. So over time, the most important thing to a fixed income investor, the ones that have been hurt very badly this year, is to have a positive rate of interest, because the reinvestment rate, the rate at which coupon payments come due and get rolled over, or new monies get invested, those are really the things that determine what the return is for the fixed income investor. If you went to 0% interest rates, what would you do as a fixed income investor? There'd be nothing to do.
Yeah.
So to have higher interest rates, the silver lining here is that the higher interest rates actually puts meat on the bones for a longer term bond investor, and it has brought valuations on stocks down to a level that has put some meat on the bone for the stock investor by making valuations more rational than they were a year or two ago. And it's in there that the seeds of recovery and longer term good things happen.
So last question on the economy and the market in that tie. The stock market is a leading indicator of the economy, right? It kind of leads the economy, right?
Yeah.
Generally, typically. So as I watch things unfold, I'm always amazed by what the market does in response to sometimes some of the news that's coming out, and sometimes it just doesn't seem to act rationally. So a lot of the talk right now seems to be, actually, I'm so happy to be talking to you and hear all your positive remarks and silver lining remarks, because that's not typically what you hear on the network shows. They're still, I mean, the rhetoric is still hot and heavy about recession, soft recession. It's still hot and heavy, but yet, my goodness, October has been a phenomenal month for the market in the midst of the rhetoric getting hot and heavy about recession. Make sense of that for us. What's going on?
Well, the media never makes a lot of money out of making long-term projections. I mean, I think I think the financial news shows and Twitter and they're making a lot more money today than, let's say, the Farmer's Almanac is. So to have this longer term view of things doesn't really sell newspapers, as they used to say. But ultimately, we're having a little bit of a rally here. This is wouldn't make too much of it. But when you look at where we are, I'd say number one, you have to have a longer term point of view. We talked about that. Now I want to take a shorter term view of things. What we've seen this year, the first half of the year, we had a very significant inflation threat. Over the summer, the bond market became skittish about recession. So the focus has shifted in the last 6 months in a short-term view from worry about inflation and overheating to higher interest rates and the potential for a recession. And you're seeing it because long-term Treasury rates are falling relative to short rates as the Fed raises interest rates. And that's an indicator that a recession is more likely. The other thing that we're seeing is that the earnings forecasts on companies are starting to roll over. So that's kind of indicative of potentially a recessionary kind of environment. The third thing that we see at Washington Crossing, we track the performance of what we call A quality stocks versus F quality stocks. A quality stocks would be those that are more flexible, more predictable, more durable, companies with like low debt and profitable assets, consistent businesses. Those high quality stocks, let's say the A quality stocks, those are finally performing better than, let's call it, the F quality stocks as the summer took, kind of wore on and into the fall. So I think that the market is actually worried that we could see some recession in the next 6 months, 12 months, 18 months. The only thing I would throw out there, though, is that for a garden variety recession, a 20-30% kind of reduction in stock values is about what you would expect. And we've already had it, to your point. So the good case scenario is that you have a relatively mild recession, and then you move on, you get to the other side of that, market can perform better. Because once the market, kind of as I was saying earlier, once the market already expects something and has priced it in, it can cope with it. So
it goes back to the expectation.
It's looking more likely that we're going to have a recession, but the good news is that it is, to some extent, priced in.
So it goes back to the comments about the market didn't expect interest rates going up. Interest rates started going up, shocked the market. The market's expecting recession. Recession happens. I mean, the day they come out and say we're in recession, the stock market could go up, right? Because the stock market's like, yeah, of course we knew that. But investors, yeah, we kind of had an idea. Maybe it won't go up, but you see my point.
Right. And then, of course, getting back to the media will be very much focused on losses. Investors hate, you've heard this one, I'm sure, 1,000 times. Investors hate losses twice as much as they like gains.
Yep.
So if you want to get people's attention, the bad news sells on the front page of the newspaper. And so that's what you're going to hear about all the time.
One last thing that we'll cover real quick, and then another hot topic, because it sells, are midterms. Everyone's talking about the midterms in the market. Should we be worried? Should we be worried? What's oh my gosh, if this party wins, then this is going to happen. If that party wins, then this is going to happen. I tell people, look, investors are going to make money. Doesn't matter who wins. The stock market doesn't like uncertainty. And when we're leading up to a midterm, there's uncertainty. The stock market just wants to know what the rules are going to be, and then we'll figure it out.
First of all, I have two kids in college, both of whom are taking midterms now, are very, very stressed out about their midterms. So as soon as he said midterms, my brain immediately went to college midterms. But yes, the midterms are coming up, and you can hear the drumbeat now. Essentially, the bet. Typically in midterms, the incumbents lose. They lose some ground. That's so if you just looked at history, there would be some expectation that maybe maybe you would end up in a situation where there's a little more gridlock in Washington. Ultimately, if you look at as an inflationary gap, an inflationary problem, which is what we seem to be confronted with today, the textbook remedy for it is to raise interest rates, basically tighten up on monetary policy, which is happening. And then the other part of it would be to cut spending, government to cut spending and raise taxes, essentially shrink the budget deficit, which if you ended up with more gridlock in Washington, that's probably what you would end up getting. But the good news would be that that response to kind of shrink government spending, raise taxes, shrink the deficit, that's the textbook answer to an inflation problem. So if you were to get a more if the Democrats were to lose some seats and you ended up with a little bit more gridlock, and as a consequence you ended up with a little bit of a smaller budget deficit, in a sense, it would be almost what the doctor ordered, at least if you read any macroeconomics textbook is what you're supposed to do to cure an inflation problem. So I don't know that would be the worst outcome.
Okay, cool. So, Xavier, I've been asking all the questions and we're coming up here to the end of the call. So do you, you have any comments or questions or anything before we wrap up?
No, keep it rolling.
You just learned. We're taking you to school. Kevin is taking us to school today.
I am going to school right now. I'm learning a lot. So
this is beautiful, Kevin. All right. Closing remarks. Anything else that we didn't talk about that we need to be thinking about that should be on our radar? I mean, everything you said. I feel like we're singing from the same hymnal. Like we are. You're talking about long-term perspective. That's what we talk about. The idea of having someone help you manage emotions and making decisions, so important. So give us something here to close us out if there's something that we're not thinking about.
I think it's always helpful to make investment decisions, to put it down on paper. Making decisions in your head, driving to and from work, or in the shower in the morning while you're trying to figure things out, it's not the best way to do it. So to put something down on paper, to have a plan, to go back periodically, revisit that plan, to find people that you can confide in and talk to, so that as things change in your life or your situation changes, or you even have questions, that you can have a sounding board, someone that understands, that can reflect back to you what you're saying. Because the reality is that, yes, this can be very mathy and it can be very scientific sounding with a lot of jargon, but the reality is that the market is made up of individuals, all of whom have their own emotions, and even the professionals are emotional. They're humans, so by definition, professionals are subject to certain biases too. But I think if we find people in life that we can talk to and confide in and bounce ideas off of, that process can lead us typically to better places, greater wealth, and avoid some of the pitfalls and mistakes that typically can trip us up along the way. So keep that longer perspective, understand that yes, we're going through tough times. Acceptance is key to that. And if you can find someone to talk to and bounce ideas off of, someone you can trust, build that relationship over time. That relationship can be the most valuable thing that you really ultimately have as an investor.
Man, I love that. I was having a conversation with someone the other day that we called it emotional math. Not all financial decisions are made with dollars and cents in mind, that we have to realize that we are emotional beings, and sometimes emotions are very bad advisors. Sometimes they're telling us things that we need to pay attention to and lean into. So, man, Kevin,
right.
thank you for your time. I know you're busy, and I know you have a lot of analysis and stock analysis to go do. Things seem to be changing minute by minute. Erik, thanks again for the introduction to Kevin and Xavier. I hope we brought you to school, man.
Appreciate you guys coming. I learned a lot today.
You could be a PhD or done.
Definitely. Thank you for taking me to school, guys.
Thank you guys for having us, and let us know if you ever want us to get back on. I know Kevin's always looking forward to teach a class. So
awesome. All right, guys.
Thank you.
All right, guys. Take care.
Thanks so much.